Okay, good morning. Wednesday, 26th of April. Let's get the briefing underway and recap some of the major news and what we're looking out for in the session ahead. Firstly, from yesterday, obviously we had the Nasdaq breaching kind of uncharted territory. The stats have been flying in this morning. Deutsche Bank looking at the break of the 6,000 level. Noting that it's taken 17 years to fill in the last 1,000-point gap in terms of 5 to 6,000. It took only 49 days to move from 4 to 5,000 back in the year 2000. But overall, this promise of a large-scale corporate tax reform in the US continues to lift short-term market sentiment in terms of the boost that we had yesterday to breach these new uncharted territories for the Nasdaq, and then obviously in terms of the Dow and the S&P getting back in towards close proximity to the few weeks ago when we were at those highs respectively of 21,000 and 2,400. General risk on tone then to yesterday's session. Still a bit of an overhang from the French election situation. Obviously the positive outcome of Macron going through against Le Pen. Obviously a slight political wobble or mistake you could say from Macron yesterday about the way he celebrated his victory, some would say prematurely, but still generally speaking that kind of lifted sentiment overall yesterday. It'd be interested to see now whether that kind of dissipates slightly as people now look to Trump for the next market inspired move. But quick look at the charts first and where things are trading. Quite interesting to see the euro just pulling back down towards pivot here more recently. The dollar's seen a slight pickup since we've come into the market today. But forget the dollar has been broadly weaker yesterday amid really the euro or ongoing euro strength. Not only have you had this quite aggressive gap up and which has been maintained since the French election result, we added to it. We broke technically that level yesterday afternoon. There was that hawkish leaning think tank report, which also was repeated in a Reuters source comment about now that the French election is kind of almost a done deal. Does this now mean that the ECB can get a little bit more or make some noises toward policy tweaks in a more hawkish manner, i.e. raising rates in the near future? And so euro shot higher, and we've managed to maintain a large portion of that overnight before just breaking down slightly back towards pivot here more recently. Downside then, just sub that level. If we move any lower, probably be keeping an eye on that previous opening high that we had from Sunday night. So pivot 0937 followed by 0929 there on the downside. Elsewhere, in terms of the European equity markets, looking at the DAX here, it's moderately lower. It's found a little bit of resistance here through the cash open the last kind of half an hour or so in terms of the futures. Likewise, Euro Stoxx sitting around its lows, but by no means a large sell-off this morning. Quite a lot of corporate earnings in focus. Just quickly to give you some of the headline readings, the biggest stock performer on the upside, these guys, Kering, which if you're not familiar with the name, is basically a fashion company, clothing, so they have had extremely good results, revenues far exceeding market expectations. They are up 9% at the moment, whereas Daimler, on the flip side, they're slightly negative, even though they did raise their outlook for 2017 on a surging profit from their Mercedes-Benz luxury car unit. Don't forget we did hear from them, I think it was last week, or we heard from one of the other German car makers, so the market's probably already kind of positioned for some positive updates from the company, and so has already been factored in that respect. Another car maker, just to cover off the sector, you've had PSA, so Peugeot Citroën, their first quarter revenues rise by 4.9%. So car makers, fairly healthy conditions for the last quarter, and as a bellwether for some of the fashion brands and clothing companies from luxury names, they've also been fairly positive this morning, so maybe just to be aware of. Obviously, earnings was another big reason for the big move higher yesterday, and this goes to show that you should be watching with great interest or planning in preparation for, is today a big day on the corporate earnings scene? Yesterday you had roughly 18% of the Dow reporting, which included the likes of Caterpillar, McDonald's, just to name a few, but there were several large cap names. As such then, just a quick recap, this is the Bloomberg earnings calendar. You can simply find it by just searching it on Google. I'd be doing this check not really in the morning, more so I'd be doing it at the end of each day, looking a day ahead here. And basically I just scroll down and I'm looking for, out of these names, anyone who's got a larger market cap or who is a sector kind of bellwether name and could therefore influence the futures price if they're reporting pre-market when we're looking or we're involved in those trading hours. And just scrolling down here, one of the bigger names or more familiar larger company, Boeing, they are reporting. Boeing always report pre-market, but just scanning down, no one else really too significant is coming out today here that really stands out. There's Twitter from a more tech-oriented point of view. They're a smaller firm, but for single stock pickers, they're quite a high volume stock. So definitely these sort of things you need to be preparing for. You already saw how the market used that really as a catalyst for the next push higher. One of the other things, just before we get into the overnight news and talk about Trump, because that's the big topic for today, is just a quick look at the Aussie dollar, because I know there's quite a few of you who do trade that currency. There were CPI numbers for Q1 which came out overnight, hence the reason the Aussie is a little weaker this morning. CPI came in at 0.5%, below the expected 0.6, year on year 2.1, below the expected 2.2. So despite moving back in toward their target kind of band of inflation, it was a fairly significant jump on the prior quarter. It was slightly weaker than expectations. We're down here in Aussie dollar at S2, and that also just around these levels brings into play some of the support seen down on the 19th of this month. So maybe just keeping an eye there on the Aussie dollar. Any break of that 19th, then you kind of got a cluster of price action, that almost triple bottom seen down at 74.64. So at around these levels could be quite interesting for the Aussie technically. So just keeping an eye on that as well as we go through the session today. Okay, down to business. Let's talk Trump and corporate tax. And the headline you're probably reading this morning is about Trump tax plan will sharply slash corporate tax rates. So a couple of the headlines here from the president is proposing to slash corporate tax rate and offer multinational businesses a steep tax break on overseas profits. Looking at the actual numbers here, you need to be aware of. So he's calling for a sharp cut in the top rate of pass-through businesses, including small business partnerships and sole proprietors, to 15% from 39.6%. In terms of the income tax rate paid by public corporations, that'll be 15% from 35%, and allowing multinationals to bring in overseas profits at a tax rate of 10% versus 35% at the moment. You know, so these are huge cuts to corporation tax. He's literally taking a sledgehammer to the current existing rates. And not only is he looking to bring it down to 15% on the kind of benchmark rate, what has caught some attention this morning is about allowing multinationals from overseas to bring back, repatriate their cash back into the US at a discount rate of 10%. You know, these are pretty monumental sized proposals. Putting this into a bit of perspective, and something we did look at yesterday, but just recapping if any of you aren't aware of the current kind of corporate tax rates in the larger OECD countries. So the US at 35% is by a long shot really the highest rate, closely followed by France, but those two countries really stick out comparative to people like Germany, where the rate is sub 16. In the UK, obviously, we're at 20%, and then scaling all the way up to the US right at the top. So a move down to 15 in terms of competitiveness on a corporate tax rate would drop them all the way back down in the bottom half of the table, almost comparable to the likes of Ireland, where of course there is a number of large multinationals based, particularly in the tech sector and of a US basis. So hopefully that kind of makes a bit more sense about how drastic this cut is that's being proposed. Now, very interesting article I've read in the FT this morning, and it covers a few interesting points, which I think is pertinent to cover this morning, given when his speech is probably going to come out later today. Congress is going to be really key. So attempting to such a steep cut in the key rate would raise a host of procedural questions in Congress. And don't forget, it's this procedural process going through Congress and these hearings, revisions and votes that has failed to see the repeal of Obamacare go through. So by no means, the fact that he's proposing these corporate structure or restructuring, does it mean that it will actually come to fruition. If the headline-grabbing reduction is not offset with revenue-raising measures elsewhere, that's where Congress will likely have an issue. It would also sound alarm bells among deficit hawks in the GOP, given that the US is facing a renewed ballooning of its budget deficit. Now, having a look this morning, I just wanted to see what the state of play was with the US government debt to GDP in a percentage terms. You know, where we sit at the moment. I mean, we're looking back here to kind of 2015, 104.17. But you can see here, through the depth of the financial crisis and the creation of non-standard monetary policy instruments like quantitative easing, the US balance sheet has just ballooned, and as such, as a consequence, their government debt to GDP ratio has soared. You know, it's gone from a very manageable pre-financial crisis 64% all the way up to 100 pretty quick fashion, and it's kind of stayed there and gradually moved higher. And so a lot of the deficit hawks obviously are going to be questioning this plan, given the huge amount of tax receipts generated from a higher corporate tax rate, such as in the US. So a repatriation tax of 10% has been proposed on companies' trillions of dollars offshore earnings, with hopes of raising that revenue gap then that would be lost by the drop in the overall corporate tax, if that makes sense. So a cut in US corporate tax from 35 to 15% would cost $2.2 trillion in lost revenues for the US in a 10-year period. That's according to a tax foundation think tank. They're saying that rather than paying for this by broadening the tax base, the Trump administration has suggested tax cuts can pay for themselves by generating higher growth, i.e. more business comes to where the US because it's more competitive in terms of corporates can make more money paying a lower tax rate, and also you have this period of an artificially low repatriation rate of 10%, which means the cash comes back in, stimulative measure for companies to reinvest and grow their businesses. Therefore, net default, the economy picks up, economic growth in the US picks up, and therefore that can help generate more income that way. The think tank, though, does go on to say that the US would need to see a sustained 0.9 percentage point increase in its growth rate over 10 years to make up for that kind of loss of revenue, about that substantial tax rate decrease. One thing here, we'll have a look at in a second about the individual companies and the amount of money offshore, because it's a very interesting graphic. But while the US has passed unfunded tax cuts before, so don't forget, he's not breaking really new ground here. It has been done at the start of the George W. Bush and Ronald Reagan presidencies, but the one difference, and the key difference here, is the chart that you're looking at. The public debt was much, much lower back in those eras. You know, if you look back here to where we are at the moment, we are getting up in towards where we were during the Second World War. That's how indebted the US is becoming in order to keep this dream alive. That is the equity market at these hugely, what could be argued, overvalued levels. This creation of these monetary policies that have been in play have seen this level get the highest point really that it's been now since the 1950s or late 1940s, post Second World War, to put it in some context. Okay, looking at the Nasdaq, obviously it breached 6,000, the Nasdaq comp, for the first time. One thing that some of you might not be aware of in terms of terminology, but certainly was a big thing probably about a year or 18 months ago, was called the FANG stocks. If you've not heard of the FANG stocks, this is Facebook, Amazon, Netflix and Google. Now these are seen as, let me just show you the share price and it will kind of make sense. They tend to be highly responsive in terms of market appetite for risk and an assessment of the global economic kind of forward-looking forecasts. And so you can see here all four of these stocks have ramped up substantially. I believe this is looking at 2017. Facebook has risen since 2017 began. Don't forget, this is 4 months ago. 27%. Amazon are up 21%. Google 12%. Now, it's well ahead of the S&P 500, which has only gained 6.5%. So the S&P index is up just shy of 7%. Facebook are up nearly 30% on the back of this kind of risk-on rally at the moment that's being very much encapsulated by this idea of this kind of deregulation of the market, tax cuts, infrastructure building, obviously the fiscal play, all dependent on Trump. One of the bigger things as well, and that's particularly relevant for these types of companies, is the fact that tech companies in particular would stand to gain the most, or one of the most. So financials have benefited a lot from the talk about deregulating the onerous regulations on financials that have been in place since the crisis. However, tech companies would benefit the most from his tax agenda. And this is because, according to Moody's, the sector accounted for 55% of the some $1.3 trillion of total US corporate cash held overseas in 2016. Now, I did find a chart here that's looking at US companies' holdings the most offshore cash. I mean, this is slightly dated, it goes back to 2015, but this is the kind of most up-to-date I could find. But look at Apple. Apple has a whopping amount of money just sat there on the sidelines through tax havens such as Ireland, if you like, which has a corporate tax rate, I think we saw earlier, back down at kind of 12.5% type level. But what they would be dying to do is, if the US were to say for a finite period of time, we're going to drop our rate for overseas money to 10%, then they can bring all that money back in-house, back to the United States domestically. And if you're looking at the types of companies by sector, this is what we mean by the fact that the Nasdaq and these companies have seen such a strong performance in the last couple of months, because you've got Apple, Microsoft, IBM, Cisco, Google. These are all related sectors for the tech industry, and hence their outperformance is so substantial in that respect. So Trump's going to be really key today. I do not have a set time on when he's going to be speaking, but you know how Donald rolls in terms of on Twitter. He tends to wake up. Today's a big day for him. I would imagine the way he tends to operate is unlike a normal politician who would want to prepare, have a definitive time, have a press conference, and then deliver the main headline. I wouldn't be surprised if Trump goes down the avenue, given his background, of just geeing up the market, so to speak. So some tweets around that regular time of 11:30 would not surprise me, where he'd be saying something no doubt in capital letters along the lines of "Tune in, hear the big news, corporate tax reform is coming!" exclamation mark, something along those lines. Whether or not that would move the market, I doubt. The market has factored this in, hence the aggressive rally yesterday. Now it's about details. Now that's what we need to hear today. The important thing I think about the announcement today is that from the press and the numbers we've just discussed, I think we've pretty much heard everything that Trump is going to say today. Because don't forget, all of this needs to go through congressional hearings and be debated and be voted on, revised potentially, and so on and so forth. You saw what happened with the inability to pass through the repeal of Obamacare. I would imagine this tax issue would go down a similar route, given the more fiscally minded hawks on the GOP will be very anti-cutting corporate tax rates by such a large margin. This is by no means a done deal, but obviously the market is priced at a point where we're expecting this to go through. If it doesn't, that's when we could see a potential pullback. So I'll keep you updated through the morning as and when I get more concrete timings. Normally I get hold of a schedule of his kind of day's agenda a bit later in the morning, so I'll keep you updated with that. Otherwise, quick look elsewhere. Let's go back to the charts and look at crude oil, because there has been a bit of a move overnight. In particular, if I just circle this part here, which is the decline in prices seen after what was a fairly substantial move going into what was the traditional pick close kind of time at 7:30. We then dropped at 9:30. Of course, this was amid the release of the API crude oil inventories. A quick look at what we're looking at. The headline for the APIs last night, so your benchmark reference then for the DOEs we'll get this afternoon, was a build of 897,000. Expectations were for a draw of close to 2 million. So we were, you're talking a sizable amount away from consensus estimate in that respect. So a surprising build, and another big build on the breakdown was gasoline. Gasoline, a build of 4.5 million. Expectations were for only a build of 500,000. The one caveat was Cushing, which was down near a closer draw of 2 million. But overall, headline reading, a build, a surprise against a 2 million drawdown or so. Gasoline, a very big build. And so if you look at the chart, that will explain the reason why we had a bit of a downtick here. We have recovered since, but we still remain proportionately lower, trading at 49.41 than where we were pre those numbers, which was more akin to around 49.70. So we'll be keeping an eye on that later. One of the interesting things, obviously, in oil over recent sessions has been since we really got our way on Friday through that 50 level, we seem to now have settled below that price point. Certainly yesterday that was the case. And if we go any lower, a lot of the questions are how low do we need to go before there's more serious risk of kind of verbal intervention. And I think you really need to go back a couple of weeks to when the market was really panicky about the speed of US output ramping up. And that was when we hit a low point, pretty much spot on the $47 handle. And so what tactically OPEC will not want to do is get in the habit of commenting on every decline that happens in price. What happens then is the market, the impact value of their comment will diminish over time, and they're fully aware of that. And so what they'll probably do now, hence the reason they've been fairly quiet, is unless this price starts breaking 49 and we see another broader move down to 47, that's probably when we get through 48 to 47, they'll start looking to protect that previous low, I would imagine, from a commentary point of view. Russia, of course, a real key component of the market believing the ability of the cuts to have any type of underlying impact. and Russia at this point are still kind of saying it's a bit too early to make any decision on the end of, or the expiry of the deal in June, and so on and so forth. So they've not changed tact yet. But if it gets down to that lower price point of that range we're looking at really for 2017, then certainly I would expect the Russians then to start upping their game, because don't forget also it's to their detriment if the price gets too low as well. But at this point they can probably weather that storm a bit longer. Quick look in cable, because that was relatively it's been a relatively quiet story for cable over the last, well, since the snap general election was called. Obviously it was the big move that we had on that Tuesday, I think it was, and then since then we've kind of gravitated in toward what would be today defined by R1 on the daily pivots. On the downside, the low 127.76 are just above S2, and we're kind of very rangy, mid-range in that pivot at the moment today. Unless we really get to the upper bound or lower, doesn't look too interesting, and I wouldn't want to get too caught up in the noise at the moment in what otherwise is a fairly quiet ranging market. The one thing that could shake up these currency pairs, of course, would be a big move in the dollar. If Trump can somehow unveil very detailed plans and structure about the corporate tax deal, and follow that up with some sort of commentary, whether from himself or other politicians, that they're warming to that idea, then you could see some dollar strength, I would have thought would be your initial reaction. And then consequently, these pairs could see a bit of a pullback. When you think about euro dollar, it is quite highly priced in the context of the sharp gain that's been seen since the French election result. So some dollar strength, if it were to come into play in that scenario, could open up some downside here. Certainly S1, 109 handle, and then the bottom of the range thus far from this week, seen at 108.84 or 108.48, excuse me, and a half. Okay, quickly then, just to wrap up on the calendar. I'm afraid it's not the most exciting day in terms of economic data, so Trump is really taking center stage today. From the morning, there really is nothing happening. So this is a perfect example of being patient this morning for the newer traders out there. This is about just being patient, knowing that the bigger move will be coming later on today when Trump speaks. In terms of actual data, you got Canadian retail sales. These are always quite backward looking. These are actually February numbers, so unless you're looking at the CAD currency, then the broader assets are not going to pay much attention. And then obviously following the APIs, you get the Department of Energy crude oil inventories. They'll be coming out usual time at 3:30. There are no other central bank speakers that are scheduled for today. Okay guys, it's your brief then for this morning. I would say keep it real this morning until later on this afternoon, and then things should liven up, and that will probably provide you with your best trading opportunity. Okay, good luck, have a good day, and I'll see you in the chat room.